opportunities you wish to speak about. What's the first one that you would like us to touch on today?
Yeah, so this might not be my best idea, but it might have the most imminent catalyst because it's earnings season. It's already earnings season for the banks, but they're going to announce earnings in maybe a week or two. And the company, it's a logistics company called Forward Air. They do less than truckload, so something smaller than a cargo container, but bigger than a mail parcel. So the Amazon truck can't deliver it. It's not big enough for a cargo container. They do some business for Home Depot when somebody orders a specialized stove or a refrigerator and they want it custom delivered. That's a LTL, less than truckload delivery. The thesis here is, well, there's what's going on with the company, and then there's what's going on in logistics generally. And there's always this kind of trade-off if you're a thesis investor or if you're a value investor. But the thesis on logistics, during COVID, everybody was buying stuff. They moved out into the country, they bought a house, they built the deck and the privacy fence, and they bought appliances. And it made this huge supply chain logjam. There was 100 ships that couldn't unload off the port of Long Beach in California. And that sent the day rates for cargo ships through the roof. But that caused companies to realize, hey, just-in-time delivery was all swell when things were working smoothly, but when things are bad, just-in-time delivery is no good. So they built up inventory. They took their cash flow, invested it into working capital. They built up an inventory of raw materials. They built up an inventory of finished goods. But then you fast forward a couple of years, and the supply chain, at least in the US, got mostly unkinked. And then interest rates went from 0 to 5. And they said, wow, the opportunity cost of holding all this inventory is suddenly really expensive. And things are working smoothly, so we don't need it. So we've been in what's referred to in the jargon as a destocking cycle. All these companies have been lowering their inventory. And as they run out their inventory, that means nobody needs trucks and nobody needs manufacturing. So we've been in if you just use, this is why so many of the recession indicators have been signaling, because it has been a manufacturing and a trucking recession, just from the destocking of inventory, across the board. But that's got to be getting to an end here pretty soon. I mean, we've pretty much retraced that whole inventory destocking. I don't know if it's this month or next month or 3 months, but at some point the inventory is run out. And even if there's not a boom in the economy, just to switch from running down inventory to maintaining a flat inventory would be a boom would be a relative boom in manufacturing and trucking. So that's why I was looking at logistics companies. Also, just seasonally, the summer is the best time for shipping. You have kind of a lull, or people buy stuff before Christmas, the stores do anyway, but there's a lull just after Christmas. So we're coming off of a slow period seasonally. So it should be strong cyclically, should be strong seasonally. And then on top of that, if Trump wins the election and puts all these import tariffs on, that would decrease the amount of ships coming in, but it would increase the amount of land freight being moved. So there's 3 real strong potential tailwinds for logistics. Now, Forward Air is a bit of a mess. They wanted last fall, they announced an acquisition. They wanted to acquire a private company called Omni Logistics. So one of the frustrating things is because they're private, we don't have all of their, we don't have all their financial filings. So we don't really know how good this acquisition was. The management team, and this is why I'm always looking for something like New Fortress Energy, where the CEO owns 1/5 of the company, give or take. The management team really treated investors like management teams do. They were contractually obligated to bring this to a shareholder vote if it was going to cause this much dilution. And instead of doing that, they just got clever. They said, well, we're going to structure it with some preferred shares. And if you don't vote to enforce the preferred shares, you'll have a big loss. Anyway, it was too clever and too disrespectful of shareholders. And then there were lawsuits. So the shareholders start suing. The acquired company, Omni, starts suing to enforce the acquisition. And it was a mess. And in the end, originally, it looked like it was going to be a very friendly acquisition. The CEO of the target was going to become the president of the joint company. It looked like it was going to be a pretty good marriage as far as management was concerned. And management should have been mindful of their fiduciary obligation. They should have been respectful to shareholders. They should have tried to sell the acquisition, maybe buy 20% and give it a year and let the shareholders come around, but they didn't. So right now, it looks like a giant mess. It looks like a complete failure. Both CEOs, the acquirer and the target, have resigned in disgrace. So now we have a new CEO. The merger was forced to go through. So you have a merged company with a new CEO. And the only data we have was from last quarter, the month of February. They had joint financial data from the merged entity, which really just showed that they made enough money to cover their interest expense, that they weren't a melting ice cube, which is a very small amount of data, but it's pretty good data because that part of the year is cyclic or seasonally slow for logistics anyway. So in a seasonally slow month, they weren't a melting ice cube as a joint entity with all the debt and dilution from the acquisition. So sometimes finance is about an auction under disagreement. Like, I really like Medical Properties Trust. There was a new short report today that argued that Medical Properties Trust, they're going to have to fire sale all their hospitals. Well, that's a disagreement. I think that if your tenant goes bankrupt, the landlord doesn't have to sell their assets. And this short report seems to think that if the tenant goes bankrupt, the landlord has to sell all their assets. So, and maybe there's something about bankruptcy law I don't understand. Maybe I'm wrong, but this is a case of disagreement. And sometimes finance is an auction under the unknown. And this one's really an unknown. We don't really know what this combined entity looks like. We don't know if this new CEO is the right guy for the job. But as far as imminent catalysts go, the very next earnings report is going to be 3 full months of what this joint entity looks like. And if you look at the collapse in market cap, and keep in mind now the company has acquired Omni Logistics, so it's a much bigger company. And I mean, the price collapse was enormous. And this is a world where you could have 3 massive tailwinds going forward for the next couple of years. So I think it's a pretty interesting setup. The reason why I think it might have been a good acquisition is it made sense. It was plausible. So Forward does less than truckload shipping, and Omni is a total logistics solutions provider. So if you're a business, you have your logistics provider. And sometimes if the business needed to ship something less than a truckload, Omni would hire Forward to do that work. Now, Forward had been trying to get into that business. They had been trying for years to organically grow these customers to be the one-stop logistics solutions provider. And after trying to grow this business organically for a couple of years, they said, it's really hard. These customers do not switch, right? If you're the logistics solutions provider for an enterprise, you're not going to change people's minds. So that gives me some kind of idea that acquiring Omni and all of their customers might be a really good acquisition. And on top of that, to kind of show, so when the stock price fell from 110 to 70, management got together and they coordinated a cluster buy. They said, hey, let's tell the market how strongly we believe in this acquisition. And you have pretty much the whole board of directors and the entire C-suite make an inside purchase around $70 a share. The CEO dropped $1 million. Some of the directors dropped $300,000. Some of the corporate officers dropped $75,000-$100,000. But these were—
Sorry to interrupt. Was this the now former CEO?
Yes, yeah.
And
the former CEO, disgraced, dropped $1 million buying stock in the company to show how good of a merger it was.
Okay,
I mean, he should have been sacked.
At $70, $70 a share, roughly. So I'm looking at about what, October last year? It would have been.
October last year is massive cluster buys. It's almost the entire board of directors and all the C-suites. It's a huge inside purchase. So, and management typically knows operationally if things make sense. I find management is sometimes clueless about the cyclicality of their own business, but at least they know their own operations. And so management was saying that this merger made sense. And just by how difficult it is to acquire these customers, even though all acquisitions you have to overpay somewhat, combine that with currency debasement in the United States and these 3 possible tailwinds coming for this business, I think it might have been a very good acquisition. I think you might find, I don't know if it's going to be this earnings call or 6 months or 9 months from now, but at some point you're going to find, as long as the CEO does a reasonably capable job, you'll have a merged enterprise that is, much bigger than before the merger, that they can service their debt. They're in no imminent risk of bankruptcy. And then when the tailwinds come in, I think you're off to the races. So I don't like the world where there are real unknowns. I'd rather just be able to do more research and figure stuff out. But where Omni was private, and there's only 1 month of consolidated earnings, it really is an unknown there. But some people like that roll of the dice. It's not my favorite thing, but it's one of the most imminent catalysts. I think they're going to have their earnings call in 2 weeks. So if you want to dig in and do your own due diligence, I think this one's pretty exciting.
It certainly does seem to be an imminent catalyst. I'm going to throw a few metrics at you for consideration. So what would the assets be worth listed on the accounting? The price to book value is at 0.7. So you're probably getting a discount to replacement cost there. On the earnings side of things, analysts have this thing, they're expecting forward 2-year EBITDA growth of 24% year on year. Top line revenue 44%. So they seem to agree with your take that things are going to pick up. You've got, I think it could be a case of, like my Uncle Rick says, what can't get worse doesn't, and what can't get better doesn't, because this thing is down 80% over the last year on price from 121. Then our mates bought in at $70. And from there, it dropped down to a low of $11.21.
Yeah.
So that hurts. Last thing that sticks out to me, net debt to EBITDA, 2.8 times. It's okay. It's within the 3x rule. When I used to go to the bank and say, please give me X amount of money, it's less than 3 times EBIT for this purchase I want to buy. Any real landmines there? Any real potential landmines?
Well, valuing logistics company, it's not this kind of company is not really about the assets. I think the best metric to value it on would be price to sales. And in normal times, it would trade at a price to sales of 1.5. What is that currently? It's at
EV to revenue is at 1, let's call it. Yeah.
Yeah, so it's a $660 million market cap for a $1.5 billion revenue company, but that's a pre-merger, right? What is so trailing 12 months is not going to show after the two entities are combined.
Yeah.
And when the two entities are combined, you're going to have a much larger company. And if it returns to 1.5 times sales, call it 2 billion of revenue, trading at 1.5 times sales would be a 3 billion market cap, and it's down here at $660 million. So that's just to return to, past value. That's assuming there's no synergies, that when they take all these client relationships and they start upselling them to use Forward as their less than load carrier, that they don't do any upselling, that there's no synergies there. And there's always a few synergies because you don't need two human resource departments and things like that. So there's always somebody to fire. But yeah, I think the setup I used to get excited when I found something that had the possibility of going a 2x, and this is something that has a possibility of going 5x. And I don't think the risk of bankruptcy is really all that great. Just, again, there's only 1 month that we only have February. February, the combined entity was profitable enough to service the debt. And then if you add on to that the seasonality, the cyclicality, whether or not Trump wins and implements tariffs. And the other thing about Forward Air is, I forgot to mention this, the less than truckload LTL shipping space, it's not very consolidated. There's a lot of competition there, but they're the quality leader. So they have the least number of dings and scratches and missing shipments. So they're the quality leader in the space. And we're going on a manufacturing construction boom. So as all these factories from reshoring get built, and you need some odd end piece of equipment shipped to your factory, and these, manufacturing equipment is critical and extremely expensive. I think there's another tailwind for being the quality leader in the space, for saying, hey, there's expensive, important components that have to be moved around. Let's go with the company with the fewest dings, scratches, and missing parcels.
Okay. Interesting. So Forward Air ticker FWRD, and Worth an options punt if you're an options degen?
So I just bought some. I mean, I nibbled at that cluster buy. I bought a tiny position at $70, and then I bought I think I 4x'd my position size when it hit about $19, and then I was really mad at myself when it hit $11. But another thing about it, so I'm not really that savvy when it comes to the technicals, but as I've been watching this thing over the last couple of months, and there's been an announcement that there's an activist investor has taken a stake in it. But on a day like today, when the whole market is down, forward air is green. So it feels to me like somebody that knows something is buying it. It's been grinding higher even on bad days. And so I think the technicals here are saying that, you know, people that know stuff, people that can value this company well, they're buying and they're building a sizable position. So I really think this one has, I mean, do your own due diligence. Don't buy it just because it's like I'm trying to be a pushy salesman. They're not paying me anything for this. But I think this one has an expiration date. I would be really surprised after the next earnings call, you know, it'll be $50 a share or $10 a share, but I don't see much in between there, right? It's the next earnings call is going to take away a lot of uncertainty, and then we'll know pretty much what path they're on. So I think that's, but I still think it's a couple years of maybe paying down debt and rationalizing the acquisition. I like to look at things for a couple of year time horizon. I don't like look at things for the next earnings call, but this thing is really imminent. I mean, there's going to be some uncertainty taken away here.